Hey everyone, welcome back to the channel. Today, we're diving deep into a comprehensive analysis of AppLovin Corporation, ticker App, a major player in the mobile advertising and app monetization space. If you're looking to understand whether this stock is a buy, hold, or sell, stick around because we're breaking down everything from financials to recent performance and even a SWOT analysis. Let's get started. All right, before we jump into the numbers, let's set the stage. AppLovin has been making waves in the tech sector, especially with its focus on helping app developers market and monetize their products. But with a stock that's seen some wild swings lately, down over 40% in 2026 alone after massive gains in prior years, there's a lot to unpack. We'll look at their revenue, earnings, valuation, and much more to figure out if this is an opportunity or a trap. So, who is AppLovin? Based in Palo Alto, California, and founded in 2011, AppLovin is a software-based platform that empowers mobile app developers with tools to grow their user base and generate revenue. Think of them as the behind-the-scenes tech that connects app creators with advertisers and publishers. Led by CEO Adam Foroughi, they've built a business that's deeply embedded in the mobile ecosystem, working with a wide range of partners globally. With just over 1,500 employees, they're not a massive operation, but their impact in the app economy is significant. Their market cap sits at a hefty $128 billion as of the latest data, and they operate in the highly competitive software application industry within the broader technology sector. Let's talk money, specifically revenue. AppLovin has shown some seriously impressive growth over the years. In 2025, their full-year revenue hit $5.48 billion, up from $4.71 billion in 2024, which itself was a jump from $3.28 billion in 2023. That's a compound growth story that's hard to ignore. Breaking it down by segment for 2024, their advertising segment brought in $3.22 billion, while the app segment contributed $1.49 billion. Geographically, the U.S. is their biggest market, accounting for $2.69 billion in 2024, with the rest of the world chipping in $2.2 billion. This balance shows they've got a strong domestic base, but are also tapping into global demand, which is a good sign for scalability. Now on to earnings. How much of that revenue is actually turning into profit? AppLovin's latest results are nothing short of staggering. For 2025, they reported a net income of $3.33 billion, translating to an EPS of 9.84. Compare that to 2024's net income of $1.58 billion and EPS of 4.68, and you can see the profitability explosion. Even back in 2023, they were at $356 million in net income, with an EPS of just 101 cents. What's driving this? Their gross profit margin is a robust 86.5%. And their net profit margin is an eye-popping 57.4% as of the trailing 12 months. These numbers suggest they're not just growing revenue, but also getting incredibly efficient at turning sales into bottom-line gains. Diving into their most recent earnings call for Q4 2024, management painted a picture of confidence. They highlighted a 44% year-over-year revenue increase for the quarter, driven by strong performance in their advertising platform. They're also seeing big wins with their AI-driven ad tech, which is optimizing campaigns and boosting margins. Leadership emphasized their focus on expanding into new verticals and continuing to invest in technology to stay ahead of the competition. They're optimistic about future growth, but are clear that sustained investment is necessary to maintain their edge. This kind of forward-thinking strategy is encouraging, though it does come with execution risks we'll need to keep an eye on. Let's zoom out and look at the broader financial health of AppLovin through their balance sheet and cash flow statements. As of 2025, they're sitting on $2.49 billion in cash and cash equivalents, with total assets of $7.26 billion against total liabilities of $5.12 billion. That gives them a solid equity base of $13 billion, a big improvement from $1.09 billion in 2024. Their current ratio and quick ratio both stand at a healthy 3.32, showing they've got plenty of liquidity to cover short-term obligations. On the cash flow side, 2025 saw $3.97 billion in operating cash flow, with free cash flow matching that number since there were no major capital expenditures reported. Return on equity is an impressive 249%, and return on invested capital is 58.2%, signaling they're using their resources incredibly efficiently. However, a debt-to-equity ratio of 1.66 reminds us they're carrying some leverage, which could be a concern if growth slows. So, what's AppLovin worth? Let's talk valuation. Right now, the stock trades at $308.62 per share, with a trailing PE ratio of 42.47, which is high compared to the broader market, but not outrageous for a high-growth tech name. Their price-to-sales ratio is 24.4, reflecting the premium investors are paying for that top-line growth. Looking forward, analyst estimates for 2026 show a forward PE of around 41, dropping to 31 by 2027 and even lower in later years, suggesting the market expects earnings to grow into this valuation over time. Compared to the software application industry average, PE, of 62.9, AppLovin actually looks relatively reasonable. Enterprise value stands at $142.7 billion, factoring in their debt load. While the numbers don't scream cheap, they do suggest that if growth continues at this pace, the stock might still have room to run. All right, let's break down AppLovin through a SWOT analysis: strengths, weaknesses, opportunities, and threats. Starting with strengths, their revenue growth is a standout, with that 44% year-over-year increase in Q4 2024 showing they've got serious momentum. Their profitability, with an 84% adjusted EBITDA margin, is another huge plus, reflecting operational excellence. On the flip side, weaknesses include their high valuation multiples, which leave little room for error if growth stumbles. They've also got a decent debt load, which could weigh on them if interest rates stay elevated. For opportunities, their AI-driven ad tech is a game changer, potentially widening their moat in the competitive ad space. Expansion into new verticals could also fuel future growth. But threats loom large. Intense competition from giants like Google and Meta could squeeze their market share, and regulatory scrutiny like the ongoing SEC probe reported recently adds uncertainty. Plus, macroeconomic headwinds could dampen ad spending, directly hitting their core business. Let's check out AppLovin's recent performance on the charts. The stock has had a rough start to 2026, down 41% year-to-date, after incredible returns of over 700% in 2024 and 100% in 2025. Over the past month alone, it's dropped nearly 26%, though it's up 14.7% in the last week, showing some signs of recovery. Over 5 years, though, the picture is brighter, up a staggering 542%, which speaks to the long-term growth story. Compared to the broader technology sector, which is up just 9.9% over the past year, AppLovin has been a standout, even with recent pullbacks. Looking at short-term moves, there's volatility to consider. The stock popped recently on bullish app marketplace outlooks, but that 29% drop after their best quarter ever shows how sentiment can shift fast. If you're a trader, watch for momentum shifts, but for long-term investors, these dips might be buying opportunities if you believe in their fundamentals. Now, let's try to pin down AppLovin's intrinsic value to see if the current price makes sense. Using a discounted cash flow approach, we'll factor in their free cash flow growth, which has been robust at $3.97 billion in 2025, along with a conservative growth rate and discount rate to account for market risks. We'll also consider their forward earnings projections and the competitive landscape to ground our assumptions. After running the numbers, the intrinsic value per share comes out to a range that suggests AppLovin might be slightly overvalued at $380.62, though not by a wide margin if they sustain their growth trajectory. The forward-looking estimates and high margins give some cushion, but the high PE and recent volatility mean there's risk baked into the current price. For long-term investors, this might still be a reasonable entry if you're betting on their AI tech and market expansion paying off. Just don't expect a bargain right now.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, Join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our Stock's Intrinsic Value Calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.